When life knocks you down, and life will knock you down, try to land on your back. Because if you can look up, you can get up. Welcome to Fire with Dr. Ninja Turtle.
Hi, everyone. Welcome back to Fire with Dr. Ninja Turtle. In this episode, I'm going to talk about debt to income ratio because about a year ago, this really hurt me, was my debt to income ratio. So let's back up a little bit. 35 years ago, when I was coming out of a homeless shelter, I had bad credit, I had a car repossession, I had credit cards in default, and I had to start from there and rebuild my credit. So since then, I have rebuilt my credit and I have not been denied a loan since I started rebuilding my credit. Well, about a year ago, I had 2 properties under contract and I was denied a loan by the bank on these 2 properties because they said my debt to income ratio was too high. And I was embarrassed because I've never been denied a loan on rental properties. I had these properties under contract, and that was my word to the buyers that I was going to buy their properties. So let's talk about debt to income ratio. Now, what that is your debt to income ratio, and how it's calculated is your gross income, your gross usable income. And when I say gross usable income, what I mean is sometimes people have income, but they may not declare the income. Let's say you have under the table income. Let's say you have side hustle income where you get paid cash. That may not be declared. Also, if you have a rental property that you are not declaring to the IRS per se, that you are not paying taxes on and deducting maintenance and those kinds of things, which is fine, you can't call that income. Banks don't take that unless you're paying taxes on it and you're taking the maintenance and deductions on that rental property. So you take your gross usable income and you divide that by the total current payments that you have. So if your total payments are $10,000, the bank may have a percentage where they say, we won't loan you more than 45% of your total payments that you have each month. So we'll make up a number. Let's say that you have $10,000 in payments each month. The bank, with your new loan included, will not loan you more than $4,500. They don't want to see that you have more than $4,500 in payments. So if you have $5,000 in payments, you could get denied. And that's probably what happened to me, is the bank looked at it and said, he's got way too many payments, then we have a percentage to loan. Now granted, interest rates were going up, and so banks were getting scared. And that's one of the jokes that I like to tell, which is banks will give you an umbrella when the sun is out, but as soon as it starts to rain, the banks take away the umbrella. And I heard that years ago, and that's true. So as interest rates went up, loans went down, and that's what happened to me. And so I wanted to tell you that it's not about being debt-free, because I may never be debt-free. I may always owe on my rental properties. And one of the YouTube videos that I watch is Ken McElroy. And he is a billionaire who invests in real estate. And he's also a friend of Robert Kiyosaki. And so I'm going to have a link down below to the video that I watched where he discusses that he is $780 million in debt. But he's also a billionaire. So his debt to income ratio could be high, but his percentage of actual debt is low compared to his actual assets. And so that's what I'm trying to do, is I'm trying to have assets that are higher than what my income and my debts are. So that's what I follow, are people like Ken McElroy. And like I said, I'll link the video down below. One of the things that I wanted to let you know is the percentage of real estate and other investments that I have. So 75% of my assets are in real estate. I have 17% of my assets in retirement accounts. So this is heavy in real estate. And the last little percent, which is 8%, are in just after-tax brokerage accounts. So I'm in the process of diversifying and still keeping the real estate, but focusing on moving the money more into retirement accounts and brokerage accounts so that I'm a little more balanced. However, I'm very happy with my real estate portfolio and what it does. One of the things that I will tell you is it doesn't matter how much real estate you have. It matters that you have some real estate, because in California, 2 pieces of real estate is equal to 10 pieces of real estate in the Midwest. So it's not a matter of how many you have. It does matter how many doors that you have. But before I get to telling you about the doors versus the properties, I'm going to ask you to please like and subscribe and recommend my channel to anyone you think has been knocked down by life, like I was knocked down by the bank a year ago. Life still knocks me down, even in retirement. Now, I have a question for you in the comments. If you know your DTI, please put it in the comments. If you don't know your DTI, put it in the comments. I will tell you that I do not know my actual DTI because I'm trying to increase my savings rate, meaning my debts are going down and my income is going up. So what I'm doing is I'm reducing my DTI over the next year. And one of the things that I did to reduce my DTI was that I sold a property this year and I paid off 2 other properties with the proceeds. Now, I could have taken the money and gone out and tried to put it down on more real estate, but I decided not to do that. It's called turtling, which, as you can tell, I'm Ninja Turtle, but this is called turtling, where you go inside your shell and you regroup. And that's what I'm doing. After I was turned down for these 2 properties, I decided it's time for me to regroup. So for the next year, I am paying down my debts, which lowers my debt to income ratio. So what does this mean? Well, what it means is that I have so many doors, right? And we talk about properties, and properties, the number of properties doesn't matter, because somebody could have a 3-unit and a 2-unit, that's 5 doors. So the number of doors is really what counts. And so I have a certain number of doors. And so what happened was I sold 4 doors, but I paid off 3 doors. That's what I did. And so that increases cash flow. And that's what I was trying to do, which allows me to increase the amount of my savings rate, which I talked about in the last video. So you have to have a plan and a strategy. Now, having said that, next year, I plan to buy more real estate. I'm hoping that interest rates come down. I have saved up enough money that my savings can put a good down payment on my real estate. What I've done in the past is I've borrowed lines of credit. I've done all sorts of things to put a down payment on real estate and paid all those off. So I don't owe any lines of credit. I don't owe any car payments. I don't owe anything except my real estate. So that's what I owe on right now. But I want my rental properties to buy me more rental properties. That's my future strategy. So our quote of the day is, the question is not who will let me. The question is who will stop me. And so I will end the video with this. Remember, never let your past determine your future.